All right, today we're going to go under the hood. We're going to see how the smartest operators navigate the super complex worlds of tax and international mobility. We're going to break down these systems, really understand the cause and effect, and pull back the curtain on the strategies that are used to operate within these powerful rule sets.
So, we've got 4 key areas to cover. We'll kick things off with how to structure a business for success, and then we'll dive into the unique power of real estate. From there, we'll look at the international playbook for global operations, and finally, we'll tie it all together into a core set of rules for mastering the game. Let's get into it.
First up, structuring. Look, this is so much more than just paperwork. The type of company you choose fundamentally dictates how every single dollar of profit is going to be taxed. It is, without a doubt, the bedrock of any solid financial strategy. And this right here illustrates the first and maybe the most critical decision you'll make. So on the left, you've got a pass-through entity like an LLC. Here, the income just flows directly to the owner and gets taxed once. Simple enough. But on the right, the C-Corp, that creates 2 taxable events. First, the business pays tax, and then the owner pays tax again on the profits they take out. This choice, single versus double taxation, it changes everything that comes after. Now, for the owners of those pass-through businesses, this number is a really big deal. 15.3%. That's the self-employment tax rate, covering Social Security and Medicare. It's a huge cost that gets applied to every single dollar of profit, and figuring out how to deal with it is a major driver of more advanced strategies.
So, how do you deal with that 15.3% tax hit? Well, one of the most common ways is with an S-corporation election. What this does is it strategically reclassifies your income, letting you split it in 2. You pay yourself a formal salary, and yes, that part is subject to those payroll taxes. But the rest of the profit, you can take that as a distribution, which is not subject to that 15.3% tax. It's a really powerful way to separate what you earn for your labor from the returns you get for being an owner.
Of course, you can't just game the system. There's a really crucial rule you've got to follow. You can't just pay yourself a $1 salary and call it a day. The IRS requires you to pay yourself a reasonable salary. Basically, what would someone else get paid to do your job in your industry? Getting this number right is the absolute key to making the S-Corp work and staying off the audit radar. It's a strategic trade-off.
Okay, let's switch gears and talk about our second engine, real estate. The tax code treats property differently from pretty much any other asset out there. And believe me, that's not by accident. The rules are intentionally designed to encourage private investment in housing, and that creates this unique, powerful system for building wealth and tax efficiency. And this brings us to a central paradox, something that kind of blows your mind the first time you hear it. You buy a property, its value goes up, you're collecting rent, cash is coming in. So how on earth can it possibly create a loss on your tax return? Well, the answer is in a powerful deduction that doesn't actually cost you any cash. The answer is something called a paper loss, and it's driven by depreciation. The government lets you deduct the building's value over a set number of years, as if it were slowly wearing out. But here's the key. This is a non-cash expense. No money actually leaves your bank account, but it creates this massive deduction on your tax return that can completely wipe out the real-world profit you made. So how do the pros maximize this? They use a tool called a cost segregation study. Instead of just depreciating the whole building over, say, 27.5 years, this study breaks the property down into its components, things like carpets, appliances, light fixtures, you name it. This allows you to accelerate the depreciation on those items, basically pulling huge tax savings from the future into the first few years you own the property.
But here's where the strategy becomes truly next level. See, normally, those big losses from long-term rentals are considered passive, which means they can only be used to offset other passive income, like from another rental. But there's a game-changing exception. If you run a short-term rental, we're talking an average stay of 7 days or less, and you're actively involved, those losses are no longer considered passive. They can be used to directly offset your main income, whether it's from a W-2 job or another business. This can literally drive your overall tax bill down to zero. Okay, now we're going to pivot from domestic strategy to the international stage. It turns out that the same level of analytical thinking applies to global mobility. It's a different rulebook for sure, but it's just as complex, and it governs how you can operate and, crucially, where you get taxed. For entrepreneurs, two of the key visas are the E1 and the E2. The main difference really comes down to what gets you in the door. The E1 is for treaty traders, and it's based on a significant continuous flow of trade back and forth. The E2, on the other hand, is for treaty investors, and that requires a substantial injection of capital into a U.S. business. So one is all about the volume of commerce, while the other is about putting your capital at risk.
Now, it's so important to understand the reality on the ground right now. Expert analysis is showing a major systemic shift. It used to be that immigration services might presume you were eligible, but that's changing. Now they are demanding comprehensive, proactive documentation right from the start. These requests for evidence are becoming the new norm, which raises the bar and stretches out processing times for anyone who isn't perfectly prepared. And for U.S. citizens living abroad, another really complex system comes into play: double taxation. Unlike most countries you see, the U.S. taxes its citizens on their worldwide income no matter where they live. This means you can get taxed by the country you're living in and by the U.S. This creates a huge financial hurdle for anyone with a global career, and it's a structural problem that's getting a lot of attention right now. So after looking at all these different systems, what are the big principles that tie it all together? This isn't just a list of tricks or loopholes. It's really a framework for thinking proactively and navigating strategically. Let's just boil it down to the key takeaways. First, structure dictates taxation. Your choice of entity is everything. Second, you have to leverage government incentivized activities, like providing housing, where the rules are actually designed to help you. Third, active participation is often the key that unlocks the biggest benefits. Fourth, document everything, proactively. The current environment absolutely demands it. And finally, strategy must always come before action. Planning isn't something you do later, it's the very first step. And that really leaves us with one final thought. These systems, with all their moving parts and complexity, they operate on a fixed set of rules. The variable here isn't the game itself, but the player. So the critical question you have to ask yourself is this: are you just reacting to the rules as they come, or are you building a proactive strategy to navigate them?